Hi everyone, welcome back to my channel. So today's video will be a breakdown of the top US stock market indices. So I'll provide a comparison along with analyzing the performance and structure of the major five. So of course this includes the S&P 500, the Dow Jones, the Nasdaq 100, the New York Stock Exchange Composite, and the Russell 2000. So if you're new to trading or just unfamiliar with what makes each index unique and how traders can use them to read overall sentiment, hopefully this video will help. And then towards the end of this video, I also want to briefly discuss how to trade the VIX to manage risk when volatility spikes. So I'll cover this at a high level for investors and anyone looking to understand the relationship between large cap strength, tech momentum, and small cap market behavior. Now keep in mind that these are just the US based indices. Obviously, there are foreign markets like the European, Asian Pacific, and even emerging and global markets, but the primary focus of this video is just centered on the indices here in the US. Okay, so let's jump right into it. Y'all can see I have SPX pulled up here on the chart. And of course, this is the S&P 500 index. Now this tracks 500 of the largest US companies across all sectors. And this is like a benchmark for US equity performance. But I do want to briefly mention that many stocks are included in more than one index, thus serving different purposes for how they function economically. So with that in mind, you can trade the stocks based on cyclicality, volatility, and momentum and other factors as well. Now, the reason I mention this is that every single index is going to perform differently. So for example, stocks on the S&P may not even perform the same way stocks on the Russell 2000 would because it's a little bit of a different ballgame of cash flow that's generated, because in this case, it's a small cap versus a large cap. So before I get too deep into this, I do want to pinpoint the fact that a single company can be part of more than one market segment. So there is some overlap that you'll see. Now to provide a quick example, let's say I pull up Apple here on the chart. Now Apple trades off the Nasdaq exchange, but it is included in the S&P 500, the Dow Jones Industrial Average, and the Nasdaq 100. Microsoft, for example, does the same thing. You can see here it trades off the Nasdaq, but it's also in all the other three major indices as well. So the same stock can be represented in more than one index simultaneously. And you'll notice that's a commonality amongst large cap stocks, because a company can belong to both a market cap based index, for example, the S&P or the Russell 2000, and an exchange based index like the Nasdaq 100 or the New York Stock Exchange Composite. But I definitely don't want to confuse anyone. It's important to note that an index and an exchange are two different things. An exchange is a market where stocks, options, and other securities are traded, like the New York Stock Exchange, for example, or the Nasdaq. So it's basically the platform where buying and selling happens. But an index, on the other hand, is a measurement that tracks the performance of a group of stocks. It doesn't involve trading directly. It's used to determine how a specific segment of the market is performing overall. So definitely want to make sure that's super clear. But yeah, getting back to it, only smaller or niche companies tend to be exclusive to one index. So keep that in mind, that a micro cap listed on, like, let's say the New York Stock Exchange and a small Nasdaq listed growth stock might only be in the Nasdaq 100 or the Russell 2000, depending on size and liquidity. But again, I'm going to show y'all all the examples that are needed. But I'm basically just saying that large caps almost always overlap across at least two major indices. So for beginners, it just makes more sense to know that the fact of the companies can be part of more than one, and some are just simply selected by size. Some are exchange listing, and then some are specific rules. So for example, like tech only, and that's essentially what dictates the fact that overlap is pretty common. Now specifically, the S&P 500 is the most widely tracked benchmark in the world. It is market cap weighted, meaning companies with larger market value, like for example, Apple, Microsoft, or even Amazon, these influence its movement more heavily than smaller firms, which is why you'll tend to see higher volatility on these types of stocks. So you'll likely see quick runs to the top or drastic sell-offs, especially when you're trading options. Now, the key elements of SPX are that it covers about 80% of the total US equity market capitalization, and it's balanced across, again, all 11 sectors. So it gives it a broad view of corporate America since everything is represented. And oftentimes you'll hear institutional investors talk about the fact that it's the overall look of the US economy as a whole because it can dictate corporate profitability by just simply telling you investor sentiment. Now, for day traders, it mirrors the general market and it can help you identify macro trends that are either bullish or bearish in cycles that affect nearly all stocks. Now, traders often use SPY ETF options to capitalize on these moves. And it's also similar to like a benchmark for hedging, swing trading, and directional option plays, since it reacts to news rather than be on inflation, interest rates, or GDP reports. Now, y'all have heard me say plenty of times that SPY is basically going to mirror the movement of the S&P 500 since it is the ETF. Okay, so now when we go ahead and take a look at the Dow Jones Industrial Average, which is of course DJIA, it's important to keep in mind that the Dow is often called the Dow Jones 30 because it only tracks the 30 large blue chip companies. And it is the oldest US index, so it remains a measure for industrial and corporate America. Now, the key elements that separate the Dow is that it's price weighted. So stocks with higher prices, like for example Goldman Sachs, they sway the index more than lower price ones regardless of company size. And what makes this different is that it reflects established corporations with long-standing performance records because the Dow is less technology heavy in comparison to the S&P 500 or the Nasdaq. Now again, you can see that GS is trading off the New York Stock Exchange, but that takes nothing away from the fact that Dow stability makes it a preferred reference for market sentiment during economic shifts. And that can be attributed to the fact that it moves more steadily. So if you're actually looking for the ETF for the Dow Jones, that's actually going to be ticker symbol DIA. Now, in options trading, contracts often appeal to traders looking for reduced volatility or long-term plays linked to performance. So if you're seeking to trade the Dow, this is the perfect ETF to do so, because obviously it's going to also mirror the performance the same way SPY mirrors SPX. DIA is going to, of course, mirror the Dow. Okay, so next on the list is going to be the Nasdaq 100 Index. Now, of course, the first thing that may come to mind is QQQ, so I'll go ahead and put that in, because this is probably one of the most popular ETFs to trade off the Nasdaq. Now, specifically, the Nasdaq 100 focuses only on 100 of the largest non-financial companies listed on the Nasdaq exchange. So if you're ever wondering what specific index is heavily dominated by technology, it definitely is going to be the Nasdaq. They also have their hands in biotech and digital media firms as well. So stocks like Nvidia, for example, Google, Meta, Apple, and Amazon, these are all going to be major growth stocks that you'll see traded. Now, the Nasdaq 100 index is market cap weighted, and that also yields to emphasizing the dominance in modern investing for tech. The unique factor is that it tends to outperform during periods of economic expansion and innovation. So you'll always notice those lows and those highs that stand out in this index, since tech, of course, is an industry that's emerging in a lot of ways. There's always some new innovation, and of course we know that there's so many different companies that are being valuated with crazy numbers. So for instance, I'm pretty sure y'all have heard that Nvidia's valuation has now entered into the trillions. So it's definitely a sector of the stock market that you always want to be aware of because technology is ever evolving. But going back to it, the Nasdaq 100 is centered on momentum. So if you're looking for any strategy, I will say that its volatility makes it ideal for short-term trading and option strategies like spreads, for example. Now, traders often use QQQ to speculate on tech earnings, rate changes, or innovation trends, especially since it's dominating the market currently. Now, when the Nasdaq surges, it often signals risk on sentiment, while sharp declines point to risk aversion. And this is an essential cue for active traders, because the Nasdaq exchange itself is where thousands of stocks, especially growth companies, are listed and traded every single day. So when you're looking at the Nasdaq 100 index, never lose sight of the fact that it's outside of finance. So think of it like a subset of the exchange focused solely on tech and growth firms. If you can remember that, then you'll definitely be good. Now, personally for me with options, most index derivatives such as like SPX options or Nasdaq futures, they rely on these numbers for pricing and speculation. So anytime I have a game plan to enter or exit a position, I'm always making sure that the stocks that I'm trading have not only a high probable setup, but the reward is going to make sense for how likely the stock will behave against other leaders in the same industry. So that's a good recommendation to keep in mind as well. All right, so moving on to the New York Stock Exchange Composite. Well, for this is going to be NYA for the index. And this is a broad stock market index that tracks the performance of all common stocks listed on the New York Stock Exchange, period. Now, with that alone, it's making it one of the most comprehensive views of the U.S. equity market as well. But the difference is, unlike the S&P or the Dow Jones, which focus on select large cap companies, the New York Stock Exchange Composite represents the entire New York Stock Exchange market, including large, mid, and small cap stocks. And some may overlook the fact that real estate investment trusts, known as REITs, are also included as well. They even have their hand in American depository receipts, but we won't talk about that right now. Those are just the ADRs. And they also have foreign companies listed on the exchange as well. But again, I'll cover that in another video. Now, additionally, there are over 2,000 securities within the New York Stock Exchange Composite, and it is market cap weighted. So companies with higher market values influence the index more. And the reason being is that every major U.S. industry, from energy, finance, tech, consumer goods, healthcare, so on and so forth, are all represented in this index. And because of this, the New York Stock Exchange Composite is often viewed as a total market, and it's an indicator that captures the U.S. and global influences. That's what separates it from the rest. Since many of the foreign corporations list their shares to grant access to U.S. investors, this opens the door for a wider range of trading. But it's not to be remiss that they focus on the largest and most established companies and how they're performing. So I want to be clear that these are not just US-based corporations. Now, when I'm recommending stocks that are good to trade that you'll find listed on the New York Stock Exchange, that can be everything from like ExxonMobil, JP Morgan Chase, and even Visa, to name a few. But I always like to make sure that everyone is aware that roughly a third of the listings provide an international reach. So this is what makes NYA valuable for traders who want to determine how global conditions, like oil prices, for example, or currency shifts, how they impact the U.S. exchange. Because this composite is used by institutional investors as a measure of the market's strength or weakness. So a good clue to keep up with is that when the index rises alongside the S&P, it often signals confirmation of a strong market rally. But when it diverges, it can suggest something deeper than the underlying sell-off, or rotation among sectors. And when you know how this information coincides with one another, you can use it to align trades with the economic rhythm in a sense. So I personally like to always make it a point for anyone that I'm mentoring to understand this composite, because it allows you to read the market's foundation, not just the headline names. Because this one index, once it moves in alignment with another index, it validates the market, and it can signal more reliable breakouts or sustained trends. But be cautionary for specific signals when you're day trading, because one stock may not always confirm the broader move. But realistically, understanding how this index flows can help you with your entries and identifying the true momentum shifts versus short-term hype in a specific sector. Along with that, since it covers virtually every stock on the New York Stock Exchange, the NYA reflects how many stocks are participating in an uptrend or a downtrend. So beyond just confirming if something is bullish or bearish, it helps separate the gaps in the market as well. So I say all that to say that it serves several purposes. Now, as a comparative factor, if you're looking at the S&P, for example, or the Dow, if it's climbing, but NYA is actually lagging, that signals selective buying, not a broad rally at all. Because a rising NYA reflects strong institutional inflows. It low-key drops hints at distribution or capital rotation into other exchanges like the Nasdaq. So it's really like a correlation guide in my opinion, because this composite correlates very closely with the S&P. But it offers a slightly wider perspective. So yeah, that's everything there. So now let me jump into the last major index, which is going to be the Russell 2000. So if you're wondering which ETF you can trade for this, it is actually going to be the ticker symbol IWM. Okay, so the Russell 2000 measures the performance of 2,000 small cap companies. So it's a very lengthy list. Obviously, I won't be able to cover all of that in this video, but I'll give at least a comprehensive overview. Now, because this index represents small cap growth and value stocks, it's often overlooked by institutional investors in some capacities, and it acts as a key indicator of domestic economic strength, because these smaller firms are more sensitive to economic changes, interest rates, and of course consumer spending naturally. But it does provide early signals of economic expansion or contraction, since small businesses tend to feel changes first. So if you're one who invests in emerging companies, you'll find value in the Russell 2000 because it's almost like projecting what is expected to happen, especially for companies that have strong fundamentals. So on the low, y'all, in many ways, it's more volatile at times than large cap indices due to instability in variances in liquidity. So when you're trading this ETF, keep that in mind because it's necessary for weighing market perception. But be clear, when small caps outperform, it often precedes market rallies. And you can use the movements to read risk favor and sector rotation. It pretty much just makes it a well thought out measure for both momentum and adverse plays. So you really get the best of both worlds with this. Now, all in all, each index captures a different layer of the economy, whether it's like the large cap for stability with the S&P, the industrial health with the Dow, tech with the Nasdaq, or small cap with the Russell 2000. So reading them collectively helps you determine the tone and what your next move should be. Because when you know how these indices behave, you can better calculate your risk. Because in a sense, you can use these as your own personal forward indicators, since in some ways they do foreshadow economic expansion, while also giving you a brief understanding of anything that you should be cautious of. So for me, index behavior is the foundation for reading price action, sector strength, and sentiment shifts. Okay, so as mentioned earlier, the VIX is not necessarily a stock index per se, but it's often called the fear monitor, so I do want to touch on it briefly. Because the VIX does measure the market's implied volatility based on the S&P option prices. It doesn't track stocks directly, but reflects the level of uncertainty or confidence among traders. So for example, when the VIX rises, it signals increased market fear or volatility. And then when the VIX drops, markets are typically calm and trending upward. Now I know that's a little backwards, but that's essentially how it works. And again, it's influenced by the demand for the S&P 500 options. So timing is so important when you're looking at this. And the reason I pinpoint this is that when you do see a spike in the VIX, it often coincides with corrections, creating opportunities for opposing trades. And then of course you can hedge with it as well, just because of the risk and volatility of ETFs or option strategies that can gain value in high momentum conditions. Alright, so the last thing I do want to mention in this video is that the US market indices tell a different part of the same story. So when you're doing your research and analyzing, the key takeaway is that the S&P 500 defines the standard, the Dow reflects the enduring corporate stability, the Nasdaq 100 captures growth and innovation, and then the Russell 2000, for me it shows the energy and power of small cap stocks, whereas the VIX measures the emotions that move them all. So understanding these indices doesn't just improve trading, it builds the ability to read the market's language fluently, and you can recognize shifts early and act when opportunity appears. Now, institutions know exactly how to manipulate the market, so they use the indices to measure portfolio performance, but I'll make a separate video discussing that in more detail. So a good market tip is that the indices will always dictate how the trends flow, so your risk tolerance is super important, especially if you're seeking stability without question or doubt. So if you take nothing else from this video, just be sure that you don't ignore directionally where the market is headed. It really separates those who have the experience to trade at a high level to those who are still learning. So don't feel bad if you're at that stage, because honestly, we've all been there. So yeah, y'all, that's pretty much all the main points of the indices that I wanted to cover. And with that, that'll just about do it for this video. If you did find any of this information to be helpful, y'all already know, feel free to leave me a comment down below. As always, I thank y'all so much for watching. And of course, I'll see y'all in my next one.